Warren Buffett is probably the most famous investor nowadays. He is the CEO of Berkshire Hathaway, a multinational conglomerate company. It's not surprising that many people follow the words and activity of Warren Buffett since he made a big fortune with stocks. Right now, he is the sixth wealthiest person on the planet. Lucky for us, his portfolio and activity are completely public, and we can follow his investing activity after each quarter, so we can see whether he buys new stocks or if he sells any of his positions in a company. Today, the market is very overvalued, everything looks expensive, so it's interesting to see what the big investors are doing in this situation. However, I don't believe that we, small investors, should copy exactly what they are doing. We should keep in mind that they are operating with billions of dollars, and they would probably not do the same strategy with small money. So let's take a look at the portfolio of Warren Buffett. The very first thing I notice is that the portfolio almost entirely consists of only dividend-paying companies. In fact, about 92% of the portfolio is dividend-paying stocks. I think that's an important message for us, and there's probably a reason why they mostly invest in dividend-paying stocks. Now, let's see what are the biggest purchases in their portfolio as of the last quarter of 2020. Their two biggest purchases were Verizon and T-Mobile. They are both communication companies selling phone and internet services. And I think this is not a surprise to anyone because the internet is getting more and more important in people's lives, and it became even more important because of the pandemic. Now the question is, would I buy these companies today? Well, T-Mobile is not a dividend-paying company, so I'm definitely not looking into that company. But Verizon is a dividend-paying company, so let's take a look at this one. Verizon pays dividends for 30 years now without reducing the dividend, and they are growing the dividend for 14 years now. That's already a very good sign for me. I like to buy companies like this. But the first problem I see is that they only raise the dividends by 2% a year for the past 20 years. That's not a lot. I like to buy companies that raise their dividends at a higher rate than 2%. The reason for this is the fact that Verizon's revenue is not really growing for a long time now. This is very important aspect when we are looking at dividend-paying companies. I always emphasize that don't look only at the dividend yield. The dividend yield is only one criteria because it's not a bond. Dividend growth investing is also about how will the dividend grow in the future. That's a very important question when we look at a stock. If the revenue is not growing, then they can't possibly raise the dividends because they pay the dividends from the profit. Verizon has a 4.35% dividend yield right now, which would be perfect, not too low and not too high. But they raise the dividends at a very slow rate, so it's not a good combination for me. Maybe if the stock would be cheaper today, something like $35, and that would give us a potential 7% dividend yield, I might buy the stock at that price. And what about the valuation? Verizon has a PE ratio of 11 today, which is definitely not expensive if we compare it to the market average. But I always look at the valuation compared to how the market valued the company in the past 5 or 10 years. And the problem is that Verizon was always around 12 PE for the past 5 or 7 years. So if we look at the historical valuation, Verizon is not really undervalued today, so there is not enough margin of safety here at today's price. As I said, we shouldn't always just follow the big investors blindly, we should always check the numbers for ourselves. And also keep in mind that what we see here is the portfolio of the last quarter of 2020. This means that they bought the stocks at a cheaper price than they are today. For example, another big purchase they made is KROGER, but at that time the price of the stock was around $31 and today the price of the stock is $37. KROGER is a dividend-paying stock, so it's worth looking at it. They operate food and drugstores in the United States. And this is also not a surprise. I think the biggest winner of the pandemic is the food industry. Partly because restaurants are closed, so people need to cook food at home, and partly because people were panic buying and pile up food like there's no tomorrow. KROGER pays dividends for 14 years now, constantly raising the dividends at a very high rate. The yearly growth of their dividend was 13%, which is a very good rate. But the potential dividend yield right now is less than 2%, which is not a lot. I would rather buy the stock if the price would be around $28 or even less, and that would give us a potential 2.5% dividend yield. If I look at the recent valuation of the company, the PE ratio is around 11, which is not expensive, but this stock was always around 14 PE, So I would say it's also not an undervalued company. Another two purchases of Warren Buffett were two healthcare companies, MERCK and AbbVie. Healthcare was always important in people's life, but now it became even more important. These two companies are both dividend payers. I already talked about MERCK in a previous video, and in fact I bought this stock last month and I will probably buy even more shares this month. MERCK pays dividends for 30 years now, and they never reduce the dividends, not even in recessions. This is one of the most important things for a dividend investor. The growth of the dividend was not very fast, but also not very slow, a yearly 6% on average. And considering that the potential dividend yield is 3.4% today, the dividend growth and the dividend yield are a good combination. The valuation of the company is really low now. The PE ratio is around 12, while it was around 15 in the past 10 years or so. So I believe that this company is undervalued today, and this is one of the reasons I bought it last month. AbbVie has a potential dividend yield of almost 5% today, but the problem is that AbbVie has too much debt, which puts the dividend at risk. Companies that have too much debt are at risk of cutting the dividends. This is another example that why you shouldn't just look at the dividend yield. If a company has too much debt, then the dividend yield doesn't matter, because if any trouble comes, for example, the company has lower revenue, then the first thing they will do is reduce or even stop paying dividends. Because, as I said it many times, the dividend is not a bond. They are not legally obligated to pay dividends. Companies only pay dividends if they want to pay it and if they can pay it. So this is the reason I'm not buying AbbVie right now. Of course, there is a chance that AbbVie will pay off its debt and they won't cut dividends, but I don't want to take a risk with this company. Another big purchase of Warren Buffett was Marsh McLennan. This is a professional services company providing risk and insurance services. It's also a dividend-paying company, unsurprisingly. Now, I could go into details about the dividend yield, the dividend growth, or the valuation, but the very first thing I noticed is that this company has reduced its dividend in the past. So even though they are paying dividends for 36 years now, they reduced the dividend in 2005. And as I said in a previous video, I only buy companies that have never reduced or cut the dividend in the past. Now let's take a look at Warren Buffett's biggest sale in the last quarter of 2020. Their biggest sale was Apple. They sold 6% of their shares in the company. Though Apple is still the biggest piece in their portfolio, it's 43% of the complete portfolio, which is a huge percentage. I believe that the reason for this sell is that the stock is extremely overvalued today. Apple has a PE ratio of 34 today, while it was around 13 in the past. Apple is also a dividend-paying stock, but today it has a very low 0.62% dividend yield, which is not a lot. The dividend yield also gives us a clue that this is a very overvalued stock. So it's not like they get rid of all their positions in Apple, they just reduce their percentage a bit in this company, but the remaining shares are still 43% of their whole portfolio. So we can see that Warren Buffett's investing strategy is very logical in today's circumstances. Their biggest position is still Apple, which is a great company, although it's very overvalued today, so the selling of some of the shares makes sense. And we know that some of the industries became very important in people's lives. These are the survivors, or more like winners of the pandemic, like companies in the healthcare and food industry, and also internet and communication companies. If you like the videos, please hit the like button.